Have you ever seen a headline about a giant company worth billions of dollars, and then suddenly they can't pay their bills? Sounds crazy, right? How can a business that big run out of cash? That's where treasury management comes in. Today, we're going to break down what treasury teams actually do, why they matter for investors, and how companies keep their money safe, available, and still working for them. Now, before we start, if you like simple explanations of complex money topics, consider hitting that button and subscribing. It really helps the channel, and it tells me to make more videos like this. All right, let's jump in. Imagine a company as a body. Sales and operations are the muscles doing the work. Accounting is the brain keeping the score. Treasury is the heart, constantly pumping money where it needs to go. Treasury management is basically the job of making sure the company has the right amount of cash in the right place at the right time, and that cash is kept safe while still earning something. If you're an investor, especially on the institutional side, Treasury is a big part of the answer to questions like, can this company pay its bills? Can it service its debt? Can it survive a downturn? If you think of your own life, it's similar to watching your bank balance. Paying your bills on time and putting your savings somewhere safe that still earns a bit of interest. Same logic, just more zeros. Now, treasury teams usually focus on three main goals, and you can think of them as a simple checklist: safety, liquidity, and return. First, safety. Job number one, don't lose the money. That means using solid banks, safe investments, and strong internal controls. If you're responsible for payroll for thousands of employees, you cannot gamble that cash. Losing principal is not an option. Second, liquidity. Liquidity is just how quickly can I turn this into spendable cash without taking a big loss. Cash in a checking account is very liquid. A building is not. You can't sell half of the lobby to pay for your electricity bill. Third, return. Once safety and liquidity are covered, Treasury tries to earn some interest. That usually means short-term bonds, maybe money market funds, term deposits, or other conservative instruments. Nothing wild, just enough to keep idle cash working instead of sitting there doing nothing. For institutional investors looking at a company, it's useful to ask, is this treasury function balancing all three? Or are they stretching for yield and taking risks they don't need to take? Sometimes an extra bit of return on cash can hide a lot of risk. Let's talk about one of the most basic but powerful things Treasury does: understanding the cash position and forecasting. The cash position is just how much cash do we have and where is it? Not just one account, but across multiple banks, multiple accounts, and multiple currencies. Sometimes even multiple countries. You'd be surprised how many organizations don't have a clear, real-time view of this. And then comes cash forecasting. Think of it like a calendar for money. Treasury looks forward and asks, over the next days, weeks, and months, how much cash is coming in and how much is going out? Cash coming in could be a customer payment, interest income, asset sales. Cash going out could be payroll, suppliers, rent, interest payments, and taxes. So instead of just asking, do we have enough today, Treasury is constantly asking, will we have enough next week, next month, next quarter? That forward view is what helps companies avoid scrambling for emergency funding or drawing on expensive credit lines at the last minute. From an investor point of view, strong cash forecasting means fewer surprises, fewer liquidity crises, and better resilience in a downturn. Now, where does all this cash actually live? You can think of company cash as being split into different buckets or jars. The first bucket is operating cash. This is the money used for day-to-day operations, paying suppliers, salaries, rent, and other regular expenses. This bucket needs to be very liquid and very safe. It often sits in regular bank accounts, overnight deposits, or similar instruments. The second bucket is reserve cash. This is the safety cushion. If revenue drops, if there's a recession, or if a big opportunity appears, this is the buffer. It can be invested in short-term, low-risk instruments that still allow relatively quick access, but it doesn't need to be quite as instantly available as operating cash. And the third bucket is investment cash. This is money the company doesn't expect to need right away. It can be put into a longer dated, but still conservative investment, and the focus here is a bit more on return, while still respecting the overall risk limits of the company. If you're analyzing a company, you can ask how much is reaching for yield in riskier products, and how much is locked up in ways that might be hard to access in crisis. The mix tells you a lot about how disciplined the management is. Let's look at some of the major risks Treasury teams manage. The two big ones are interest rate risk and foreign exchange risk. Interest rate risk is about how changes in interest rates affect the company's cash and debt. If the company has a lot of floating rate debt, rising rates mean higher interest expenses. If it has a lot of cash, rising rates can be a good thing, but only if Treasury moves that cash into better paying instruments. Treasury can manage interest rate risk using a mix of fixed and floating debt. And sometimes, using derivatives like interest rate swaps, you can think of fixed rate as locking in a steady payment and floating rate as letting your payment change based on the market. Foreign exchange, or FX risk, shows up when a company earns money in one currency and spends in another. For example, it might sell products in US dollars but pay suppliers and staff in euros or yen. If exchange rates move, the real value of those cash flows changes. To manage this, Treasury can use hedging strategies. In simple terms, a hedge is a second position that helps offset the risk of the first position. It's not about making a profit. It's about reducing uncertainty. Similar to buying insurance, you should spend a bit now to avoid a much bigger problem later. From an institutional perspective, the key questions are, does this company understand its exposure to rates and FX? Do they have a policy? Are they using hedges thoughtfully, or just hoping markets move in their favor? Treasury management is also about controls, banks, and systems. On the control side, you don't want a single person clicking a button and moving millions of dollars with no oversight. You'll see things like dual approvals, role-based permissions, and segregation of duties. Think of it like needing two keys to open a vault. This reduces fraud risk and simple human error. On the banking side, Treasury manages relationships with one or more banks. That includes bank accounts, credit facilities, FX services, and investment products. Diversifying across banks can reduce the risk of being too dependent on a single institution. For investors, a company that has thoughtful, diversified banking relationships is often more resilient. Then you have the technology. Treasury management systems, dashboards, and reporting tools. These systems help consolidate balances across banks, track cash movements, run forecasts, and enforce controls. The better the system, the cleaner the data, and the faster the decision making. So, why does all of this matter to you? If you're in institutional finance, Treasury management affects liquidity, default risk, and a company's ability to handle stress. A business with strong Treasury practices will usually have fewer nasty surprises, better working capital, and more flexibility in tough markets. If you're working inside a company, understanding how Treasury thinks can help you make better decisions. Whether you're in finance, operations, or strategy, you'll see why certain projects get delayed, why some cash is spoken for, and why risk limits matter. And if you're just learning about finance, Treasury is a great way to see how money actually moves inside a business. It's the bridge between the abstract stuff, ratios, models, valuations, and the real-world question. Can this company actually pay for what it needs when it needs to? To summarize in one line, Treasury management is about keeping cash safe, keeping it available, making it work without taking on unnecessary risk. If you've enjoyed this breakdown and want more topics like this, maybe a deeper dive into cash forecasting, FX hedging, or how companies actually choose their banks, let me know in the comments. Thanks for watching, take care, and I'll see you in the next one.